Okay, so give this a read. Yeah.
One year, our theme was going from good to great, and the company had bought everybody this book, and we all had to read it.
Oh, you read this book?
Yeah.
Huh.
And they made us all read it, and it all apparently went.
Yeah. Well, and Farmers is still around, so I guess that wasn't one of them. But yeah, the ones that were brought up in this book, a lot of them went. That's right. You always got to keep looking for your edge. So, yeah. So this happens. This happens quite a bit. People tend to rely on observable data, and causation versus correlation is something to keep in mind. What's the difference? Causation versus correlation. What's the difference between two variables being correlated with each other versus two variables having a causal relationship between each other? Good. Yeah, so if they're correlated, one goes up, the other goes up, they tend to move together. One goes down, the other goes down. So they're correlated to each other. All right, so how does that contrast with causation?
Causation, one actually dictates what the other one will do.
Good. So this one goes up, which caused this one to go up, right? And this one went down, which caused this one to go down. So there's a big difference there. And too often people start to mix up those concepts. And sometimes economists even are guilty of that, although economists, I would say, are the most advanced intellectuals in the social sciences that are cautious of that as much as we can be. So there are things that you can do to try to correct for that, to try to uncover whether you're doing something like that. Not to bash some of the other social sciences, but a lot of times you'll see people doing correlation coefficients and implying causation when it's not necessarily the case. And that's certainly what happened with this book. I don't know, Jesse, if you remember any of the things that went on, but I assume, I didn't read this book, but I assume they said, do this, do A, B, and C, and you'll get results X, Y, and Z, right? And they showed examples.
Yeah, that's pretty much what it was.
That was the concept. So it's kind of a business help book. Follow this game plan and you'll get these results. See, these 10 companies did it. But what they weren't realizing is that these 10 companies had a number of other factors that were going on. And quite frankly, if you're going through an economic upturn, then a lot of people are doing well. Even if they're doing bad things, they're still making money, right? And so Warren Buffett, I believe, had this quote, when you learn who's really making good decisions, who the good businesses are, when the tide comes in, you know, who was wearing their underpants and who wasn't, right? Because then it reveals who you really are. When the economy goes down or when the tide comes in, you're left showing what you were wearing. And so everything gets kind of revealed then. So if you're able to weather the storm, then you were making good long-term money. So we're trying to make a distinction between long-term results in the market.
Like the only thing I think about is like 11 companies in the grand scheme is not very many companies to look at, I guess. Like compared to all the amount of companies there are, specifically just 11 companies.
Oh, sure, yeah, right. That a very small subsample, yeah. Yeah. Which would be a good observation to be careful of. Okay. As you guys read this along, I want you to know that the author, once again, made some presumptions that you know some things about principles of economics. And so I want to review some of those, just in case they're not crystal clear in your minds, about perfect competition as well as monopoly. Because those two extremes help us think about different aspects of industry and individual firms within them. So here's our first model of perfect competition. I want to draw two graphs side by side. And the graph to the left is home base. So go ahead and draw home base for a particular market. Does anybody know what wheat is selling for? Kansas wheat? Any farmers in here? How much? And a ballpark is fine. Is that how they price that?
Bushel.
A bushel, yeah.
They're getting like 60, 65 bushels per acre, and I think the norm is 35.
Yeah, and so I guess I was thinking, is it $10 to $13 a bushel, something like that? Does that sound good? That's good enough for class, honestly. We're not have to get too big. Let's say it's an $11 a bushel. So here we are in the wheat market at home base, and there's a number of suppliers, a number of farmers that are selling wheat. And so there's thousands of bushels of wheat, big Q here, being sold at a price of $11. Now, with perfect competition, we have there's kind of three characteristics that we hang our hat on. And those three characteristics are a homogeneous product. So homogeneous means you can't distinguish one farmer's wheat from another farmer's wheat, right? A homogeneous product, as opposed to a heterogeneous product, which we'll get into later when we talk about the importance of product differentiation. When a McDonald's hamburger is slightly different than a Burger King hamburger. At the end of the day, they're still a hamburger, and they're pretty good substitutes for each other, but they're slightly differentiated. When you compare that to wheat, one farmer's wheat, you can't tell from another farmer's wheat, right? A homogeneous product. So we got a homogeneous product. We have a large number of sellers. A large number of sellers. How large? Well, I like to use this analogy that you can try to remember. If I fill this bucket half full of water, and I take one eyedropper and I squeeze one drop of water, are you going to see the bucket level rise? That's how small one company is relative to the market. So there might be 100,000 farmers. You're just one farmer out of 100,000. You're just 500 acres out of 5 billion acres being farmed. You are nothing, relatively speaking, in terms of quantity. Again, you're still a human being, and we care for you, and Jesus loves you, and all that stuff. But in terms of the market, you are nothing. You're a drop of water in the bucket, a drop of water in the bucket. So a large number of sellers. And then the last one's important. We have free entry and exit. What do we mean by free? It's relatively easy to get into the market, to start up a business and compete with other people in it. And it's pretty easy to get out of the market. So easy in, easy out. These are the three main characteristics of what we call perfect competition. So the agricultural products are probably the closest thing we have to perfect competition. Large number of farmers selling a homogeneous product, pretty easy to get in and get out, even if you got big capital equipment. You still can rent the land, you can rent the machine, whatever. So fairly easy to get in and out. So what does that imply for Farmer Joe over here? So over here we're going to have the representative firm. So Farmer Joe. So Farmer Joe's sitting over here, and we want to think about his business model. What's going on for him? Well, the first thing going on for him is him thinking about what he can sell his wheat for. What can he get for his wheat? How much can he get? $11, right? Can he get 12 if he really polishes up the wheat and cleans it good? And no, they don't give a rip about, you can't differentiate your product. You've got a homogeneous product, so you're not going to get $11.01. You're going to get $11, right? So you're a price taker. You take the price that's given to you. So at $11, if Farmer Joe makes 100 bushels, he gets $11. If he makes 200 bushels, he gets $11. If he makes 300 bushels, he gets $11. It doesn't matter how much he produces. He's just a drop of water in the bucket. And so this is effectively the demand for his wheat. Again, on this graph, I'm showing Farmer Joe. And for Farmer Joe, the demand curve is effectively perfectly elastic. It's perfectly horizontal at the market price of $11. Okay, well that has some significant implications on marginal revenue. So, marginal revenue. Gabby, you did that wonderfully earlier. Why don't you do it again for us? What is the definition of marginal revenue?
The change in total revenue over the change in quantity.
Okay, so that's kind of the formula for it. Marginal revenue is equal to the change in total revenue over the change in quantity. Could anybody re-express that into words more? If you were to write a sentence without just restating what we just did, there's something that's a little elusive thinking about it that way that I think would be helpful. When we think about marginal, what does that word mean? Incremental or additional, right? So what is the additional revenue from another bushel of wheat sold, right? So even in that problem we did, we sold 6 more, we got $46, we found out 46 divided by 6 gave us $7.50 or whatever it was the revenue per unit. So we always like to drop it down to a per unit basis. My question to you then is, what is the revenue generated by the 121st bushel of wheat? The revenue generated by the 121st bushel of wheat. $11. 133rd bushel. 156th bushel. Demand is the marginal revenue curve. The revenue generated by each additional unit happens to be equal to the price. That's a very important result. That is what this is saying right here on the screen. Marginal revenue equals price. We can sell all we want at the competitive price, so the marginal revenue in another unit is equal to the price. So this picture kind of captures that. Okay, now take this a step further. How does Farmer Joe maximize profits?
Cutting expenses.
Okay. What if expenses are set or whatever? What is the profit maximizing rule for him? How do we choose the quantity? You said quantity, Scott? How do we choose the quantity? What is the quantity that maximizes profits? Okay, the one that offers the greatest margin? Okay. So the overall margin, right? So we're trying to maximize profits. Profits are equal to total revenue minus total cost. Whatever quantity makes that the biggest would be the quantity we'd want to produce, right? All right, so let me, I guess, add in a little more data to this. Suppose we've got a marginal cost curve that is traditional in the form of being upward sloping and J-shaped. If you want, I can't remember if we did this earlier in this class or not, but I want you to draw a curve that looks like this. Let's have it go bottom out at 100, kind of a little J shape here. Goes up to 300, or cuts through at 200, and then goes on up. So an upward sloping marginal cost curve exhibits the law of diminishing marginal product. That's why the cost of each additional unit we're going up. So now that you got this information, following our rule for profit maximization, what quantity should Farmer Joe make? 200. Good. I was expecting to maybe hear somebody with a wrong answer. How many people are thinking 100? Since that's the big gap here. Okay, I'll come back to that one. Ryan, you okay with this?
Yes.
Okay. So this is the same picture we had before. Keep producing until, as long as the marginal benefit of the next unit is greater than the cost, then do it, do it, do it, do it. All right, so Skylar's question was, wouldn't we want to stop at 199 and not do the 200th? Because you're correct that the cost of the 200th is equal to the revenue generated by the 200th unit. So we are breaking even on that very last unit. So the answer is we should produce it. Does anybody know why? Because that's a little bit slippery topic. It has to do with the difference between economic profit and accounting profit, if that helps you. What do economists always include in cost? The implicit as well as the explicit cost. So by doing so, we're still earning a normal profit on that last unit, right? So there's still a little bit of profit. There's zero economic profit on that last unit, but we're still earning a profit on it. So we're still breaking even on it. Okay, so we're going to produce 200 units is the profit maximizing quantity to produce. So how much money is he making? What's that? Okay, so how'd you get that? We got 2,200. 200 times 11, is that the profit? That's the revenue. So that was price times quantity. So that's good. That's half the equation. How are we going to deal with cost? Okay, good. I'm glad you went that direction, Gabby, because what we don't want to do is look at just the marginal cost, because the marginal cost does not include fixed costs. So you said fixed and variable costs. So really what's happening here is we need more information for this particular problem. We don't have enough information to actually calculate profit. In fact, if costs were way up here, I'll just kind of draw that in and erase it later, Farmer Joe is losing money. But he's losing the least amount of money possible. Because if he produced a little less, he'd lose more. If he produced a little more, he'd lose more. So the profit maximizing quantity is also the loss minimizing quantity. So you're doing as best as you can. But the information that's missing is the average total cost curve. All right. So if the average total cost curve was down here, then there would be profit. So then we'd have positive economic profit. I'll come back to that later, so I just want you to kind of conceptually think about that profit. But what I do want to give you at this point is where it's going to be in the long run. So in the long run, we'd expect profits to be here. So the average total cost curve, remember that big dot here showed the minimum point. The marginal cost curve has to cut through the minimum point of the average total cost curve. As long as I'm thinking about it, if a problem says constant marginal cost, which we see, right, in different problems, if you have a constant marginal cost, if marginal cost was just equal to $11 and it was a flat marginal cost curve that looked like this, then marginal cost equals average variable cost equals average total cost. They're all equal to each other. And then you can do what you guys maybe wanted to do, which was to take the cost times the number of units. But that's a special kind of simplified case. All right, so how do we know profits are equal to 0 in this case? The average cost per unit, we're producing 200 because it's the profit maximizing thing to do. We go up to the average total cost curve, hang a left, and we learn that the average total cost is 11 per unit. We're pricing them at 11 per unit, then that means there's nothing left over for economic profit. Coming back down to this equation, we did one variation, remember this one? Price minus average total cost times quantity is another way to think about profits. And so 11 minus 11 is 0. This whole thing collapses down to 0. So at this quantity, economic profit are 0. All right, well, that's not very fun, having profit equal to 0, but that's the result that we get. So why do we see maybe some farmers earning profit and some not? Well, if we figure out how to, I don't know, generate electricity from wheat or something, there's some new innovation that increases the demand for wheat. So if there is an increase in the demand for wheat, what happens to price? It goes up, right? So the demand would shift to the right, price goes up, my cost didn't go up, but the price did. So the price of wheat rises to $15. Each individual Farmer Joe increases production, and now they're producing this amount at $15, and so now they're earning economic profit. At this quantity, price is greater than the average cost per unit, I'm earning a profit. Okay? So that would be an increase in demand. Now, what this chapter is going to bring us through then is, well, what's going to happen when Farmer Joe, and remember, he's just the average Joe out there, average Farmer Joe, if all the farmers are making profits in wheat, what happens next year? What is going on in terms of the wheat market? Now think about the characteristics of the market. There's more supply. Why?
Because they either produce more or they have other farmers produce other types of stuff.
Right. So free entry, entrepreneurs like profit. So I like to think of that, why I was doing this, you guys are probably wondering what the heck I'm doing. I like to think of profits as a signal. So profits send a signal to the market, and the signal that it's sending is enter me, enter me. Kind of like the bright lights of Vegas and downtown New York in Manhattan, right? It's all just, ooh, and then the entrepreneurs are like flies to the light, must go. So entry happens in the marketplace. Now, come back, it's double golf club time. What is your prediction of what's going to happen in the wheat market in the long run? That's another thing I didn't point out. This is the short run implication. because in the long run is the only time that you can change all resources, capital, equipment, labor, blah, 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 blah. In order for a new firm to enter the market, they have to vary, they have to start up with all the resources. So this is a long run concept. So in the long run, after demand has driven the price up to 15 bucks, what happens to price in the long run? It's going to go down, right? So as entry occurs, now look at what's happening. Supply increases, price goes down. How far down is it going to go? Back to 11, good. So as long as nothing's happening here to cost, then which could be happening, by the way, that's a different story we won't even bother with today. But as that entry occurs, we get right back to the spot where we were. Now notice that our ending place then is somewhere over here. So demand went up, I'll put a dash line. Demand went up, in the long run supply went up. We get right back to here. There's more wheat in the world, right? In our little economy, there's more wheat being produced. But each individual farmer is back to earning a normal profit. Remember, zero economic profit is okay. You're still earning a normal profit. You're covering all implicit and explicit costs at that point. Okay, questions or comments on that? All right, so we were kind of talking earlier about the marginal cost curve and the supply curve. This is why the marginal cost curve is the supply curve. Notice that when the price went up to $15, Farmer Joe produced this amount, right? So as price went up, Farmer Joe kept ramping up the quantity supplied. That's what the supply curve is. As price goes up, the quantity supplied goes up, ceteris paribus. We are really defining the supply curve. So in perfect competition, the marginal cost curve is the supply curve, which means that the market supply curve is really the sum of the individual marginal cost curves as well. So this represents the marginal cost to society of producing that good. So supply and marginal cost are one and the same under those circumstances. Okay, I just threw a lot at you. Questions? Might have to review the tapes on that. In principles class, I take it a little bit slower and show multiple steps. And actually, I have those videos available to you too. So I can, in fact, those should be open on Rust Econ Rocks if you go to the micro. You went through and looked at.
I didn't watch all of them, but I saw.
Yeah. So one of those will be on here too.
So, in perfect competition, when price goes up, quantity goes up.
Yes.
But if it's not perfect competition, when price goes up, quantity has to go down.
Doesn't have to go down, but it could do some other things, possibly.
Okay.
I'll go over that case next
Okay.
in a monopoly situation. But these are kind of the guts of perfect competition. And if you get a general understanding of this, when you start to see a multiple choice problem or something that looks like this, you can start to put those pieces together. So if price is greater than marginal cost, produce more, otherwise produce less. A number of these conclusions will start to come out. Yeah, Jeff?
I'm confused. Why in year 2, when supply went up, why prices stopped at 11?
Oh, good question. So let's just retrack where we were. So we started here at point A. We went up to point B in the short run. And in the long run, we fell to point C. And your question is, why didn't it go further? If prices fall, which they could possibly for a short amount of time, let's just do it. people go crazy. We saw the generator example, right? Too much entry into the market, supply went crazy, and the price of wheat falls to $8. What's going on for Farmer Joe? He's losing money. So this is still the total cost, average total cost. So at a price of $8, Farmer Joe is going to produce this quantity. And $8 is less than $11.20, or whatever this number is here. And so I'm losing $3 and some change on every unit I produce. So I have an economic loss. Now that's not just Farmer Joe, that's the average farmer, the representative firm. So now what signal's going out to all of the companies that are there as well as the companies that aren't there? This sucks. Get out, exit, negative, bad, do something else. So the existing firms are going to go belly up. Some of them that maybe aren't as fat on the cash or whatever, they can't ride out this economic downturn, they're going to go out of business, go bankrupt. So the supply is going to go back up. And so it might go through that type of process in the long run, adjustments to come back to this equilibrium. Again, as the Austrian school points out, if we ever really get back to that equilibrium where things are always in flux. Okay, anything else? Okay.
Dr. McCullough, what does it do to the market when the U.S. government provides subsidies for farmers? Does that just kind of throw it all out of whack? Because on my family farm, they would get payments for not growing crops to kind of subsidize farmers in economic times.
Well, I could probably talk for the next 50 minutes on that topic, or I can give you the 50. I'm going to give you the 50-second version, though, obviously, in essence of time. But no, great question. In fact, using this graph here, we can think about what a subsidy does. So let's go back to our original $11. If the government said, those family farmers are such tough times that 11 just isn't enough to pay the bills and feed their kids and diapers and all that kind of stuff, so we're going to give them a couple bucks extra on top of that. What do they do in response to that subsidy? Do they produce more or less? More, right? So that's one of the distortions that happens. Now, in the taking it off the market, the CRP program is a little bit different, so bear with me. There's different variances on this. But in a true subsidy, they're going to be encouraging production of that amount. And so you're going to start to see more being produced. So the other effects of subsidies is if they're giving it to wheat farmers, shouldn't they be giving it to corn farmers? Why are we giving it to wheat farmers and not corn farmers? And then, well, wait a second, why are we giving it to wheat and not the auto industry? What's the reasoning? What's the justification? Here's one of the classic things about a subsidy. If you care about human beings in general, Africa is a wonderful place to grow cotton. And the government has been subsidizing the cotton industry for years. And so to the tune of, it would make you ticked off if you learned about the amount of dollars that go towards cotton farmers from our tax dollars, and then the benefits that we end up getting back makes 0 sense. But on top of that, we are essentially keeping money from the Africans that they could earn on their own if we weren't dominating the market by distorting it by subsidizing cotton production here in the United States. Because the Africans they actually have a comparative advantage in cotton production. They would be producing a lot more cotton, and their welfare would increase, and now the Georgia cotton farmers' welfare would decrease, and of course that's why you don't hear about those subsidies, a big outcry about them going down, because then they just call up the politician and they say, well, you're going to be hurting me, and I have people that work for me, and there's jobs, the whole line. So I'm probably over my 50-second mark. But anyway, good question, Jesse. Anything else? We'll do a little bit on subsidies at a later time too. Okay, so it's a little bleak for our perfectly competitive firm. I shouldn't even really say that. It's not necessarily bleak because they are earning a fair return. But this is what we'd like to see is competition driving us to an efficient price, because there's other people on the other side, not just the farmers that we're trying to help through the subsidy, but somebody's paying for that wheat, right? And so if we're keeping prices artificially high through a subsidy, the government's not necessarily the one paying for it, right? Because they're collecting taxes from other sources to pay that subsidy, and on top of that, the price might be going up in some cases, or with the subsidy it actually could be a little bit lower, but then we're just helping the people who are buying it too. All right, so here's some evidence of what we mean by profitability in the long run. And so in the markets, we do see short-term profits or losses being eroded away. And so they call this the mean reversion of profits. So here we're measuring years, and if the average rate of return that a small business expects to make is a 20% return on capital given the risk that they're taking on, some of those companies figure out something new and hit the jackpot, so to speak, and make a bunch of money. Other companies are making less. If we start to look at a particular industry over a period of time, competition drives us back to earning a normal profit. So here, presumably a 20% return is a normal return for the risk of taking on a business in this particular industry. So some of the predictions that we make with this model are reflected in some real world data. Okay, the next thing to look at is resource prices and how things change over time. So I want to start off with this idea of San Diego in terms of housing prices. So we talked about housing earlier. Ryan, you got a particular interest in housing?
Me? Or
Yeah.
that one?
I was thinking you, Ryan H.
Yeah, sure.
So Nashville's somewhere over here. San Diego's somewhere over here.
Phoenix.
So suppose we've got a house that runs $100,000 is our initial starting place. What's going to happen to housing prices over time? Imagine we're kind of new settlers. We're aliens that drop into this land and we don't really know much about it. So this is kind of a hypothetical starting place. But at the end of the day, if we add up all the construction costs of building a house, those could be about the same, right? But if we now let these used homes go and we start to create a market for used homes, what do you expect to happen with prices if that was our starting place and San Diego's a little more attractive with that little ocean that they have down there and the perfect temperature that they have here around, no mosquitoes and stuff like Nashville deals with? San Diego prices go up, right? And so that's what we've seen. Now this house runs $1 million and this one runs $200,000 in Nashville. So why? Why are those prices different?
There's more of an attraction in San Diego.
Okay, there's more of an attraction. And go ahead. Was that Jesse or Ryan?
I was thinking the market.
Yeah. What about the market in terms of why are we seeing that happen? What are people,
Higher
higher demand, so people are mobile to move potentially, right? If they're thinking about, well, where do I want to live? I don't know, San Diego or Nashville. It's a coin flip. Well, what makes it less of a coin flip is if prices are higher here than what they are here. But initially, if we think about how the market evolved, people were attracted to there. There was an increase in demand because of these other attributes. Oops, that's a little inverted. Sometimes I do that. My brain flips around. So there was an increase in demand because of the ocean, because of the whatever, right? And possibly a decrease in demand or some other changes going on in Nashville. But those things are going to be eventually equalized in terms of what? So if we take that same $100,000, might be a bad example, but maybe not. I was in San Diego. There's still some houses like this. But if you take a 1,200 square foot, one-story, 1970s build house, again, it probably cost the same in both places originally. And we see that this one sells for $500,000 in San Diego, and it's at $130,000 here in Nashville. What is the difference? We've got how many dollars different? And what do we attribute that to? The market value, which is driven by what?
Supply and demand.
Okay, supply and demand, and what else about these physical characteristics? In other words, what is the difference here? How many? What do we got? 370,000. We got $370,000 difference. What are you buying for $370,000? Location, right? So we can attribute that to those things. In other words, if the two houses were detached and moved to Minnesota next door to each other, they'd both sell for the same price, right? So that difference is reflecting all of the other things. So that's what this indifference principle is looking at. If an asset is mobile, then in the long run, the asset will be indifferent to where it will be used. That is, it'll make the same profit no matter where it goes. So we're going to see that not only in housing prices, if there's mobility of people to move, but also in resources. So think about wages. Why do embalmers make more than rehabilitation counselors? Did both have about equal amounts of education?
Most people don't want to be involved.
Why?
Personal preference.
Luckily, it's not nasty to everybody, apparently, right? But you get that compensating wage differential, right? So the difference is driven by the nature of the work. Now, those differences can be other things too. Working at Iowa State University, they would publish how much people were making. You can look up this in state salaries, so it's all public information. And so if you took the average economics professor's pay, it was running $110,000 at the time. The average, the high was like 170 or 80, and down to 80 or something like that. And in the English department, they were making about 50 to 60, 55 or 60. So you got 110,000 versus 55 to 60. Why?
Greater supply of
English teachers.
Okay.
English is easier to learn.
Okay. I'd probably agree with that. Now, if we think about their job and what they do during the day, is that much different? Show up, teach some classes, do some research. They both have PhDs. They were both in classes for, whatever, 6 years, 6 to 8 years. So that's all the same. But you haven't quite hit on the main reason why the econ professor is making more than
greater demand.
doing what?
Teaching.
You're right. Demand doing what?
Teaching.
Publishing.
Figuring out ways to make this
There you go. Bingo. Right? So if you're in the private sector, you will earn more than $110,000, right? So in order to lure people away, economists away from the private sector, they have to induce them with a higher pay. So their opportunity cost, imagine that, is higher than what the English professor. Another way to think about it is ask yourself, if an English professor wasn't teaching English, what would they be doing? I've been asking myself that for years and years. I had a friend that was in the English department. I used to give him heck all the time on that one, right? So what would they be doing? I don't know. What would they be doing if they weren't teaching, if they didn't have a PhD in teaching at a university? So it always comes back to what you could be doing if you weren't doing what you're doing, right? What is the opportunity cost involved? What is the implicit cost? Not necessarily just the explicit cost, but what other opportunities you might have. And so the economist has other opportunities that would pay a lot more. So all of these things are give rise to what we call compensating wage differentials. These are going to be persistent in the difference in pay. So you brought up, well, what would cause us not to have a reallocation? Why doesn't English people that are thinking about getting a PhD, why don't they just switch to economics? Well, I think you nailed it earlier. Economics is a lot harder. A little bit different, which is good. All right. So how does this translate into assets and pricing and ultimately interest rates? So, how are you guys looking at this equation? How's that one striking you?
Is E what we've learned? Is E to be elasticity?
No. Glad you brought that up. So that is another way of doing an expectation operator, we'll call it. So whatever's inside the parentheses is the expected value of that. Okay? And I think I might have done one other thing where I used a superscript. I put it to the E to the superscript, but this is another way of noting the expected something, whatever's in the brackets. So, are you starting to see it now? Hopefully you've been staring at it a little bit. We got P, T plus 1, and PT. What does that mean? Price. I'll buy that. Time. So what? Give me an example of what this T and T plus 1 would be inferring.
Well, T would be like the present time.
Okay, good.
T plus 1 is the expected.
Next
plus
year. Right. So this could be 2013. T plus 1 would be 2013 plus 1 is 2014. So this is the price that I expect in 2014. And this makes it the expected return because I've got new number minus the old number divided by the old number. That was the old way we figured percentages, right? How much money did I make? How much markup do I have? New number minus the old number divided by the old number. And so there we've got it. What do I expect to get tomorrow? What do I expect the price of my house to rise to if I've got a $100,000 house and I buy it today? What's it going to be worth next year? If it's worth $120,000, I think it's going to be worth $120,000. I've got 120 minus 100 divided by 100 gives me a 20% expected return. All right, so expectations are always looking forward, and that's part of what economists gets paid six figures for, even though they turn out not to be always good at it, but making predictions, right? We're not here to tell history lessons. We're here to take the history and the data and try to make better predictions about the future. So economists are in the prediction business. And so what we've done is we've taken a twist we looked at this equation before of what's the return. Well, if we're now in time period 2014, and I've earned a price of 115,000, I can calculate my return looking backwards, which would be the actual return I earned, which was only 15%. I expected 20%, I got 15%. So it's always be thinking about, am I looking backward or am I looking forward? Okay, so the higher return on a risky stock is known as the risk premium. So when we think about premiums, we want to think about safe money versus risky money. So it's the difference between the interest rate. So if one asset is an 8% return, and another company, if you loan them $100,000, one company's going to pay you 8%, and another company out there is going to offer 12%. What kind of red flag should that raise for you about the 12% company? Should you immediately jump on and say, yeah, I'll do the 12%. Well, 12% is better than 8%. I'm going to do the 12. Should you do it?
Pay it back.
Okay, it may not pay it back. So that's what we're getting at is the risk premium. So in a competitive market where there's lots of companies and lots of buyers and a large number of sellers and a large number of buyers, if you see an interest rate differential, there's a reason. Somebody out there thinks that that company is more risky than the other. And so that difference is called the risk premium. And in that case, it would have been a 4% risk premium. All right, so it's kind of like compensating wage differentials. Now we can tie it back to the embalmer and what was it? The rehab counselor, right? So we can think about that premium that you're getting for uckiness of embalming, taking dead bodies and stuffing them full of fluids and cutting them up and messing them around. It kind of gives me the heebie-jeebies. I don't know about you. So that compensating wage differential is similar to the risk premium. Same thing with the California house versus the Nashville house. There's some sort of premium that you're paying, but it's for something real. There's real differences in the 1,200 square foot Rambler house that's in Nashville versus in San Diego. All right, questions or comments on that? All right, so 1906, this is some old data, 1900, 1906, 2002. This is the difference between government bonds and equity, stock equities in general, or companies. So the premiums have gone up and down over time, and then down a lot here in 2002. So there's probably two things that you could draw from that. What would they be?
September 11th.
Okay. So September 11th, that scare is going to drop down the difference, or is that what caused the little upturn? What are you thinking attributing to September 11th? So,
It just kind of ended on September 11th, it looks like. So I don't know.
yeah, no, that was definitely something happening at that time.
Didn't everything shut down? So
We were in a recession right before it.
Yeah, there was a recession before it. So people were looking for things. What do you think about their comfort level of equities of businesses given this as we're moving through time? So people are, tell me what's really going on here with this spread versus this spread. You know, what's going on here? I want to make sure we all understand that.
There's
Let's
not
put it
much
into words.
difference between, at the later date, there's not much difference between bond and stock interest.
Okay, and I want to be clear here that the baseline is government bonds, that there are no risks. So what we're really measuring here is the risk premium, right? This is the risk premium. In other words, you buy a United States government bond, how much risk are you taking on? How many times have we defaulted on bonds? What's the default risk of U.S. government bonds?
Oh, it happened once in the 70s.
Not that I'm aware of. That wasn't made good on ultimately.
Maybe that's what I'm
Okay.
thinking.
Okay. There, and even here as of late, there's been little scares like, is the government? But at this point, the U.S. government's been kind of as good as gold. So if they tell you they're going to give you 1% return, they give you a 1% return. If they tell you they're going to give you a 3% return, they give you a 3% return. So what's being measured here is the distance between some stock or bond that's from a corporation, let's say, how much more you're paying them. So here in 1978, what is our distance here? 2%. There was a 2% premium being paid for that. Now it's dropping down close to approaching 0 here. So, have they become less risky? Is that a possibility at least? Yeah, it is. So, have these companies become less risky? That's a possible answer. So we've seen risk go down. Maybe, one thing that I think could easily be argued from the 1930s to here is that we have more information than they ever did, that they could ever dream of, right? Go on the internet. So information flow would naturally lower that risk premium over time. Or we have irrational people going in looking for anything they can get, and that increase in demand is driving up the price of those things, driving down the effective rate of return. So we could be thinking about bubbles. And so is this irrational to be buying that when you could be buying a government bond and getting a guaranteed rate as opposed to taking on some risk? All right, so that's the idea of the risk premium. Let's jump into monopoly. Just going to give you the quick model of monopoly since we went through competition. Again, I don't think you'll see this in your book, so you might want to pay special attention to it. I believe I have these long-run models in a file saved on Blackboard. It's actually a handwritten thing. I'll double check to make sure it's there, but I'm pretty sure it's there. If a firm is a monopoly, Farmer Joe is all of a sudden it. One seller, not large number of sellers. We've got one seller. It's a homogeneous product kind of by definition. So I still like to put that, because if it's only one product. When we get into advanced chapters, though, we'll look at multi-product firms. We've kind of talked about that on and off already. On if you're selling multiple products, maybe you can do some stuff with pricing. But in our most general scenario, let's say there's one product, one seller, and then barriers to entry. Barriers to entry. So Farmer Joe now faces that whole demand curve. We're going to use our little trick here of the marginal revenue curve is twice as steep, lies below the demand curve. So marginal revenue curve looks like that for a single price monopolist. Marginal cost curve, some sort of J-shaped looking, just like Farmer Joe's was. The seller maximizes profits like any firm does by producing the quantity where the revenue generated by the last unit produced is just equal to the cost of the last unit. Marginal revenue equals marginal cost. The difference now is that they're going to charge the highest price people are willing and able to pay for that quantity. And to do that, we go up to the demand curve, hang a left, and that is the price that the monopolist will charge. Would you expect there to be profits in a monopoly situation? Yes. So let's go ahead and just cut to the chase on that. We're going to draw just an average total cost curve. I don't really care where you put it, but just draw any old average total cost curve. It does have to bottom out where the marginal cost curve comes out. Remember that little rule. At the profit maximizing quantity, let's just call it 100. The average cost per unit, you go up to the average cost curve, hang a left, and read off that number. Thinking back to our profit equation of price minus average total cost times quantity, if we rewrite it that way, total revenue minus total cost. We can identify this little rectangle as economic profit. Greater than 0. Positive profit. Now, people are going to know that the firm is making profit. That signal's still going out. But is there going to be entry? No, because of barriers to entry. One of our assumptions in the model. So there's some sort of barrier to entry. So maybe you got a patent for it, and the government allowed you to keep that patent for the next 17 years. And so you get to be the only producer of it for the next 17 years. But 17 years in one day, you can bet your bottom dollar that there's going to be 5 competitors that are going to be offering that same solution, whatever it was that you had a monopoly on. So ultimately, even in the long run, monopolies tend to fade away, one way or the other. Whether you're the Rockefellers, whether you're Ma Bell, running all the phone lines, monopolies tend to disappear. The cable company has not disappeared, but has faced lots of competition. Why? Innovation of dishes and now phone lines and other things, right? So monopoly, even the greatest of monopolies, tends to fall over time if there's a decent government in place that believes in competition. If they believe in the market system rests itself on competition. That's why the government only allows that patent to run 17 years. So they realize they want to give you enough incentive to innovate and think of something new and to capture back some amount of profit for it. So you get an exclusive right for a period of time, but then it's gone. So eventually, we want competition to prevail. All right, questions or comments there? All right, so that's kind of what we got here, some of these results off of this. This one is probably worse since we talked about this equation. Just real quick here. So entry makes demand more elastic. So there's more substitutes, so when there's more competitors, right? And this is our markup equation. So as things become more elastic, the number gets bigger, causing this to go down, which means our markups go down, right? So costs might stay the same, prices got to fall. So that monopoly price ends up going down when we start to have entry in there. So that's kind of putting that piece of the puzzle into that picture. Okay, that wraps up this one. We're not going to discuss that. So, quick 5-minute break, or 3-minute break. You can stay in your seats if you want, but just loosen up your brains, loosen up your minds.